Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell, and welcome to the Build Wealth Canada podcast. Today, I'm excited to have a panel discussion with easily some of the largest personal finance and investing personalities here in Canada. Together, they have over 46 million views on YouTube. For context, that's more than the entire population of Canada. And in this episode, I thought it would be great to pick their brains on how they actually invest their own money, what types of investments do they actually buy, what specific ETFs do they buy, and what type of investing style have they found to work best for them. And then they ask me the same question too, so you'll get a pretty diverse view of the different options out there for us Canadians when it comes to investing. You'll notice too that while some of our styles overlap, we do also diverge in a few areas. And so we also tackle what are the pros and cons of the different styles so that you can be well informed on what's out there and the pros and cons of these different approaches, allowing you to make an informed and more educated decision on what is the best fit for you. Let's get into the interview. All right, let's start by introducing the panel. Brendan, can you start by telling us a bit about yourself, your area of expertise, roughly how much you currently invest in ETFs, and tell us about the investing style or strategy that you've chosen for yourself?
Absolutely, Cornell. Well, that's an easy one. I can kick it off. I'm 100% invested and allocated to ETFs right now. So this wasn't previously the case. We can chat about that later. But as of right now, my portfolio consists of 100% ETFs. Very briefly, my background for those maybe not familiar. My name is Brandon. I'm actually joined today on the call here with my father, Mark. We host a YouTube channel together. So we've been doing that for a number of years. I actually started a YouTube channel back in 2016, 2017 with efforts to talk about Canadian investing, educate the DIY investor. Prior to that, I was actually licensed as a financial advisor here. I'm from Vancouver. That's where I'm based. And yeah, I got my licensing when I was 20 years old. So relatively young in the big scheme of things. And I wanted to marry that knowledge and education that I was getting from working actually at my father's firm for 4 years, marry that with the digital side of things, YouTube content, and getting that out to the masses. So really, that's my background. I also happen to be one of the co-founders of the Blossom app, which is a social network app that was founded here in Canada. We've been doing that for a couple of years, and that's growing tremendously. But yeah, in terms of ETF strategy, Cornell, I would consider myself an asset allocation ETF investor, a very passive approach on the market. And I get my exposure via an asset allocation ETF.
Awesome. Yeah, Brendan's being very humble. His YouTube channel is one of the largest YouTube channels in Canada when it comes to personal finance. So he's just being a little humble here, but he's definitely been at this a while. He's researched this quite a bit. And yeah, he's putting his money where his mouth is. He does actually invest in these types of ETFs as well. Awesome, Brendan. Thanks for introducing yourself. And Adrian, you're next.
Yeah, it's always bad going after Brandon. He's always a tough act to follow. But hey guys, my name's Adrian, also known as the Canadian in a T-shirt. I've been running a YouTube channel called Canadian in a T-shirt for the past almost 6 years now. I talk about everything to do with money for Canadians, how taxes work, credit cards, investing, how to start a business, real estate, all that kind of stuff. In terms of my background, I'm actually by trade, I'm a mathematician and an AI software engineer. But I've been running multiple businesses. I've been investing for about a decade now. And funny enough, Brandon was one of my biggest inspirations. He's actually a personal hero of mine. She was one of the motivating factors for me to start a YouTube channel in the first place. And I'm so honored to say that he's one of my close friends now. So it's really been a beautiful journey. In terms of my investing strategy, I have two main kind of pillars of my strategy. One is long-term investing. I only care about long-term. I don't care about short-term. Number two is diversification. I don't want to have all my eggs in one basket. I want to be spread out across all sectors. And ETFs are such a natural, organic way to accomplish both those goals. In terms of my allocation, I would say at this point, probably about half of my portfolio overall is in ETFs. Again, it does depend on each account. Like my TFSA is a little bit more heavy on individual stocks, but my corporate account, my non-registered account, those are much more ETF focused. So overall, I'd say I'm about 50%.
Awesome. Thanks, Adrian. And Mark, let's go with you.
Thank you. I followed Brandon and interrupted him many times, Adrian, but to follow you, that is a challenge, but I'll give it an attempt here. So my name is Mark, and as Brandon said, I'm his father. And it's funny, our story, because I was an investment advisor and a portfolio manager for 25 years plus. I tried to retire 4 years ago. Brandon actually worked at my firm, as he mentioned. So when I tried to retire, he said, Dad, you're not busy anymore. So why don't you do some YouTube channels or some YouTube videos? So we started doing that. And here we are going on into year 5 now. So it's pretty crazy how I've really enjoyed that. So it's nice to be able to contribute. My investment philosophy has for many years, decades now, been just long-term. I was never, shouldn't say never. When I first started investing, I was the typical get rich quick penny stocks. I was a younger guy at the time. So I learned quite early that for me, at least, long-term investing, buying good quality investments and holding them for the long term tends to work for me. As far as ETFs are concerned, most of my portfolio still today is individual securities. And that's largely because that's just what I did for a living. So for me, it wasn't a big jump to do that. But I do have I have 3 ETFs right now, one equity ETF, and I have my fixed income component of my portfolio is currently all in ETFs. It has been for many years. And so I think we'll maybe talk more about that later as far as the reasons there. But this is my style. I do believe for the vast majority of people, ETFs holds a big part. So I'm maybe a little bit of an outlier as far as the planet is concerned today. So that's my story.
Awesome. And Adriano, let's go with you, our last panelist, other than me.
Yeah, thanks, Cornell. So my name's Adriano, and my wife and I run the Passive Income Investing YouTube channel. So my story is a pretty actual boring story. Born and raised in Montreal. We both worked in tech our whole careers, and investing was more of a fun thing for me. I actually figured out that I wasn't an investor at all. I was more of a speculator or swing trader, which is a far cry from what I do now. So what happened was we discovered this newer, lesser known style of investing where I would say it's an income oriented style. So the focus really is on income, generating that consistent income, but without sacrificing performance as well. So those two things combined. My channel focuses on this type of investing with a special focus on covered calls or the covered call strategy or the covered call ETFs, because now we have so many of them in Canada and in the US. So this strategy that focuses really on consistent income enabled my wife and I to retire in our mid-30s about 5 years ago. So now we run this YouTube channel more like a hobby or a fun thing, even though it's like a full-time business now. But this strategy, or people are attracted to the channel and my strategy if they want an income supplement, if they're about to retire, if they're retired and they want to supplement their retirement. So I do have a little bit more of an older crowd that comes to my channel to see what it's all about. But that's what my investing style is in a nutshell. I'll get into it more later for sure as well. So what about you, Cornell?
Sounds good. Yeah, I'll introduce myself as well. Obviously, we're going to have this episode on my podcast, but I know Brendan is going to be posting it on his YouTube channel as well. We'll be promoting it through all the panelists will be promoting the episode. So some people maybe haven't heard of me, so I'll give my background as well. So my name is Cornell Schreiber. I run the Build Wealth Canada podcast. As of today, it's the largest and highest rated financial planning podcast that's made specifically for Canadians. So it's about 10 years old now. And really what I do on it is I interview experts like some of the experts we have here today to really share their best practices, what's worked well for them, what hasn't worked well for them, different lessons learned. And the big thing is the emphasis is on Canadians. So there's a lot of really good US content and these really big influencers and educators in the US. But then I found myself listening to them when I was first starting investing and wondering, does this apply to me as a Canadian? They obviously have different mechanics when it comes to their tax system, their investing tools, etc. And so really where the podcast is different is that it is really specifically for Canadians. And so if anyone wants to check it out, it's Build Wealth Canada podcast. It's in every podcast player. You can just use your favorite one to search it, or you can download or stream all the episodes for free over on the website, which is buildwealthcanada.ca. And then, just a bit of a background. So we hit our financial independence number when we were 32, when I was 32. I'm 40 now. So we're basically part of the FIRE movement, but we actually pulled it off. So like I said, it's been 8 years now that we've actually been living it. So I kind of juggle from being fully retired to semi-retired. I found the best balance over the 8 years is to just have the podcast, because then the brain is still working. I still get to learn the best practices when it comes to managing my portfolio and making it so I don't have to go back to work and then sharing it with the rest of Canada so that we can all benefit from these best practices. And so that's really what I do. Yeah, thanks for the intro. And then, we'll kick it off now with the first question. And actually, you know what, maybe before I jump into that, I did want to say that when we were assembling this panel, I wanted to bring people together that have some different investing styles. So a lot of us are ETF investors, but some are just pure total market index investors like myself. Some do a little bit of different things, like Adriano mentioned, for example, on his end. So I figure this way, you're going to get a few different perspectives from different people who have really specialized in a certain style of investing. There's going to be some overlap as well. And then the other component is that we are, I would say, different ages as well. So I'm 40 years old now. And then, do you guys want to say your ages? Maybe just because I want to show that we're trying to get people who are in different life stages. Like I have 2 kids, I'm 40. And so this is hopefully going to be relevant for you no matter what age group, no matter what life stage you're at. So Adrian, how old are you now?
Yeah, so I recently turned 33 years old, which is mind-boggling for me. I still feel 25 sometimes. But yeah, I'm a little bit in a fortunate situation in the sense that I don't have a family, I don't have kids, I don't have anyone depending on me. So I can live a very frugal, minimalistic lifestyle and invest like the vast majority of my income. So I'm leaning towards Cornell's footsteps. I want to follow that kind of trend. I do want to retire within the next 6-7 years, hopefully in my early 40s. And so investing in real estate, investing in ETFs, investing in dividend stocks. I do a kind of a hybrid approach. All those kind of will hopefully lead to that eventual goal of retiring early in my early 40s.
Awesome. Brendan, how old are you?
I'm 29. I'm probably the younger one here in the group. So 29 going on 30. And unfortunately, I wish I was as frugal as you guys, but living here in Vancouver, you guys know how that is. I think big expenses. I got the family. Myself, I'm a father, actually. Daughter's turning 3 actually in a couple of weeks. And the FIRE movement, we'll see how that goes. I'm just investing for my retirement when that comes, and I'm targeting a date roughly in my 60s is where I'm forecasting out.
Okay, awesome. And Adriano, what about you?
Yeah, I'm 39, going to be 40 this year. And it's just my wife and I. My wife and I are going to be celebrating our 15-year wedding anniversary this year as well, which is pretty crazy to think about. I didn't really mention in the intro, but us too, when I say we retired in our mid-30s, that's when we reached our FIRE number as well. So we are financially independent thanks to our investing style, but we do reinvest the majority of the income. But what I like to tell my audience is that let's say everything goes away, the YouTube and all our other sources of income, we would be just fine with just our investments. That's my investment income, or our investment income is always going to be considered my bread and butter, the replacement of our paycheck, so to speak. Yeah, that's pretty much it.
That's great. And Mark, what about yourself?
Okay, it's official. I am the oldest person in the group here. Yeah, I'm 62. I'm 62 years old, born in 62. And I would definitely be wealthier if it wasn't for Brandon and his brother. If I hadn't had those 2 children, man, I could so much money. But you know what? I guess that's the way it is. And now I got to try and keep it so that I can go meet my maker so that it passes along. But it's been pretty good. Yeah, I think I'm 62. Most of my, I get an outlier here because a big focus of my wealth right now is protecting that wealth to make sure that I don't have to go back to work, let's say, at some point, as opposed to growing the wealth. So and it'll shine a little bit different light. So hopefully some of the people listening will be more towards that phase of their life as well.
That's great. Yeah, that's why I thought it was great to have you on as well, Mark, and having all you guys on. Because some of us have kids, some don't. Some are more in the asset accumulation phase. Others are in the sort of decumulation or protection phase. And so your preferences on investing styles and things of that nature can change a bit once we get there. So I hear you. And now a quick message from one of our sponsors. If you're traveling abroad, you need a reliable, fast, and secure internet connection on your phone. Not just for safety, but so you can actually enjoy your trip and not constantly be searching for free Wi-Fi at potentially shady locations where often you get an unsecured connection, which can pose a security risk. Saley ensures that you always have an internet connection when traveling abroad and prevents you from being charged roaming fees by your current cell phone provider. Now, you could buy a local SIM card once you arrive at your destination, but that's a hassle since when your plane lands, you've got enough on your plate, and now you have to go hunting for a SIM card provider and hope that they don't rip you off or give you a SIM card that doesn't even work. That's why when I took my kids to Costa Rica recently, I made sure that I had my data needs covered before I left for the trip. It was less stress, one less thing to worry about when I arrived, And especially if there's a flight delay or any issue, I knew I would have data the moment the plane lands, so I can figure things out right away instead of scrambling to get an internet connection somewhere. Saily is available in over 200 countries. They have a 4.7 out of 5 star rating based on over 57,000 reviews. And you can get an exclusive 15% discount on their data plans by downloading the Saily app and using the code BUILDWEALTH at checkout. Just go to your favorite app store, search for Saily, Saily, and use the code BUILDWEALTH, all one word, when checking out to get 15% off. More details can be found in the episode's description box.
Are you buying Canadian? Well, why not invest Canadian? At BMO ETFs, we're committed to helping you build a brighter financial future because it's our future too. This is our home, and as Canadians ourselves, we know what you need to grow wealth right here in Canada. Visit bmoetfs.com for more.
Yeah, let's kick things off. I thought it would be good to start with really what I consider one of the easiest investing styles to implement and get started with, while also being extremely effective, very passive, and low cost. Brendan, as you can probably guess, I'm of course talking about asset allocation ETFs, which you mentioned is your preferred investing style these days. For anybody new to this, can you explain what asset allocation ETFs are, and then go into why you chose this as your primary investing style, along with the ETFs that you actually buy and why?
Absolutely. Your preamble there, Cornell, I think nailed all the benefits. It nailed many of the benefits involved with asset allocation ETFs. But for those maybe not familiar, when you're constructing a portfolio, and this could apply to anybody, typically if you're building in my opinion, a sound portfolio, you want to have the diversification across geographies is an obvious factor. The Canadian market, the US market, possibly the international market. You can definitely make the argument for different types of asset classes as well. And as we can tell from this group, we are all in different phases of our lives, and the portfolio should reflect that. So the concept behind an asset allocation ETF is, as the name implies, it does that job for you. But you do have the option as a DIY investor or retail investor to go out and construct that with multiple ETFs. For instance, I want to get one ETF that exposes me to the Canadian market. I want one ETF that exposes me to the emerging markets, et cetera, et cetera. The asset allocation ETF is essentially that all-in-one bundle. And what's very cool and unique about the suites of options we have here in Canada is that you can pick the allocations that are most applicable to you. For instance, what I invest in, Cornell, to answer your question, is I own a fund known as ZEQT. Obviously, do your own research, you guys. That's just the ticker that I tend to own. It's a BMO all equity ETF. And what I mean by all equity there is that the allocation between bonds or fixed income and equities, it's a 100% allocated to equities. So it's an all equity, entire stock focused portfolio. But of course, within that, you have exposure to the US market. You have exposure to the Canadian market, the international market, even some small cap exposure, which is one of the minor benefits that I liked about that fund in particular. I think to talk about pros and cons of this strategy, like I said, you nailed it. It's easy. It's simple. It's really effortless. Obviously, we always need to do our own research. We always need to stay on top of what we're doing. But in my opinion, if there's a spectrum of how much involvement or time you need to spend when monitoring rebalancing, which you really don't need to do because that fund does it for you, anything that goes involved on the management side, this is like the least amount of involvement that you need. And that to me is the major benefit behind why I chose this strategy. I was optimizing for time. I was optimizing for actually a huge thing that I don't think a lot of people talk about is the mental load, the mental capacity that it takes when you're managing a portfolio, even of ETFs, right? Because even if you're managing a portfolio of 4 ETFs, which is in general a very simple portfolio, you still need to be allocating your mental energy to whether you're on your targets and keeping up with the broader economic status of the world. And it's what I've learned for this phase of my life. It has been such a pivotal unlock that works very well for me, where I'm just trying to put as little attention as possible, but knowing that I'm allocated properly. The one thing I will say, caveat to that, and we can get into it if you'd like, is that they do come at slightly higher fees. I would still consider this a low cost product at the end of the day. But when compared to a broad-based ETF, for instance, I'm going to go build my portfolio of just an S&P fund or just a TSX fund, you are paying a slightly higher management fee. Now, again, these are in the 20 basis point range. So compared up to a mutual fund, you're still winning by miles. But there is an argument to be made to say, why don't I just build it myself? Some people can. But for me personally, I've prioritized as much hands off as possible. And that's why it's working for me.
That's great. Yeah, I find it so easy to get lost in the weeds and try to fine tune and optimize everything to the finest degree. But when I saw you making that switch, I remember you had a big announcement when you did that.
Yeah.
I thought, wow, that sounds like a really good fit for Brendan, because what came to my mind was you run Blossom. It's a big startup and it's growing. It's a lot of work. You've got a young family. And so for you, it's why don't I just buy these asset allocation ETFs or just buy one, just pick ZEQT, be done with it. And then now you can focus all that mental energy on growing your business, being a good dad, that kind of a thing. Yeah. So there's definitely, I think, something to be said for that, like you said, in terms of the headspace that it can take up. And I can relate because I do buy the underlying ETFs. I buy ZEQT as well for certain accounts, but I also do the underlying. And so I 100% agree. It definitely does take up some headspace without a doubt. So that's wonderful. Thanks for sharing. Does anybody else on the panel have anything to add? Anybody else that uses them or wants to comment?
I'll just add to that. I guess I go back long enough that in the industry where when I started in the industry, ETFs were not really a big thing. And if whatever was available back then was index only. So the whole space has really evolved. And I've just chosen to continue to what I always did, to own individual securities. But as I touched on earlier, for a lot of people, I would argue probably most DIY investors, if you're not getting help from outside from a professional, then yeah, for certainly ETFs would be a good route, and the AA, the asset allocation ETFs would probably be a really good choice for a lot of people.
Awesome. That sounds great. I'll add something to that as well, because I do buy asset allocation ETFs as well. So for my retirement accounts specifically, I buy the underlying ETFs, which we're going to get into because I know Adrian invests in that way as well. So we're going to tackle that component next. But for my kids, our ESP for their education, I use ZEQT, so that asset allocation ETF exclusively as well. My kids are young, so I'm okay at being 100% equity. And because from the hundreds of interviews I've done at this point, anytime I've asked an expert who's an expert in this in Canada specifically about our ESPs, one of the underlying themes was that you really should, or pretty much the consensus was, you really should view the RESP as its own portfolio. You shouldn't view it as a thing that's together with your retirement accounts, because they have different purposes, right? One is for your kids' post-secondary. Your retirement accounts are for your retirement. And okay, if you are subscribing to that and you're going to treat the RESP as its own separate portfolio, then asset allocation ETFs are the most efficient, easiest way to do it, because you just buy one ETF and you're done. And so that is literally all that I do with our RESP. So every single year, I max it out to get the maximum grant. And I just use all that money to basically buy ZEQT and just rinse and repeat every single year. Super easy. And I don't have to worry about rebalancing it at all, which is nice, because in my retirement portfolio, as you'll later find out, things get very complicated because I've been optimizing that to the extreme. But on the RESP side, it's a different animal. And then the only other thing I'll mention as well is that I do use ZEQT as well in my corporate investing account. Now, this is getting a bit more deeper and nuanced, but essentially, when it comes to investing, if you have your own corporation and you're investing in a corporate investment account, as a Canadian, one of the most sort of tax efficient ways you can do things is you have Canadian equities in your corporate investment account. And it's like, there's a whole kind of reason for that. However, you also don't want all your eggs in that Canadian basket, right? You do want some diversification ideally in there as well, especially if you're getting a pretty large portfolio in your investment account. And so I'll also buy some ZEQT in there as well, just so that, because I don't want it to just be all Canadian equities, right? Especially if I'm already at the weight I want for Canadian equities, I'll just throw ZEQT, and I have some money in the corporate account, I'll use ZEQT just so that money can still be invested, but also so that I'm not overweight in Canadian equities. Yeah, so that's what I wanted to say about that. And yeah, for anybody that wants to learn more about that particular subject, like if you have your own corporation and you want to learn how to invest efficiently, the best free resource that I found on that for Canadians specifically is the Money Scope podcast. So definitely recommend you check that out. It's really well done by Mark Solt and Ben Felix from PWL. Really impressive. I went to business school and I felt like I was watching a fourth-year university course. It was so good. I learned an absolute ton in terms of efficiently investing within your corporation. So I know it's a bit of a nuanced topic, but for anybody that is in that situation, like maybe you're a doctor and you get your own corporation or small business owner, I did find that to be extremely helpful. All right, awesome. So let's move on to the next question. Adrian, you like to buy the underlying ETFs instead of just one asset allocation ETF. Now, for anybody new to this, can you explain what that actually means, why you choose to invest in this way, and can you share specifically which ETFs you like to buy as part of this investing style?
Absolutely. No, thank you, Cornell. And no, Cornell, both you and Brandon, you guys hit the nail on the head in terms of the benefits you get with asset allocation ETFs. You can't beat that level of simplicity, right? You can literally just put money in, close your eyes, and they will rebalance. They will make a diversified portfolio across different asset classes, across different geographies. It's so simple. However, there is a cost to that simplicity. And Brandon also made a really great point talking about optimizing your time. With this, you really get to buy back your time. However, for someone like me, I'm not nearly as busy as Brandon is. So I have the luxury of time to do a little bit more customization and make it a little bit more tailor-made approach to solve my individual goals. And by doing so, I get to optimize both in terms of fees, but also in terms of allocation, and also I get to optimize the tax efficiency. One thing to really mention is that with an ETF, there's nothing magical about an ETF. An ETF is just a collection of assets, stocks, bonds, or a collection of other ETFs. And that's exactly what ZEQT is. ZEQT literally just contains 6 other ETFs. For me, what I do, there's a word, I invest in the underlying ETFs. What that means is instead of buying that one bundle, that one giant package, I buy those 6 underlying ETFs that make up ZEQT. But one thing that I do differently is that I'm able to customize it and make it shift around the weights. What I mean by that is, for example, with ZEQT, about 50% of that overall fund is the S&P 500, the US stock market, right? And I think 25% is the Canadian stock market. And then the rest is international, mid caps, small caps, that kind of thing. So if you do ZEQT, you're committing to a 50% US split, 25 Canada, and 25 the rest. I don't want that split. I want a different number. For my portfolio, I prefer 40% US, 40% Canadian, and the remaining 20 will be international and small cap, mid caps. So ZEQT doesn't work for me because those numbers don't line up. So instead, I buy those individual underlying ETFs to make my own allocation. So as an example, my 40% Canadian, I know with ZEQT, it contains the Canadian ETF called ZSP. That's a great approach. I use a slightly different one. I use a BlackRock ETF called XIC. Basically the same thing. Rock bottom fees. You contain 220 of the largest Canadian companies. So that one, any Canadian broad ETF fund would work. Now, in terms of the tax efficiency that I mentioned, this is where one of the benefits I get, where instead of going with the all-in-one ETF and buying ZSP, which is the US component of that all-in-one ETF, I go the US dollar route. A popular example is something like SPY, or what I invest in is the Vanguard ETF, VOO. And there's a few reasons why I prefer doing the US dollar version. Mainly, there's 2 main benefits. One, I get to benefit from lower fees. And number 2, I get to optimize my tax efficiency. So in terms of the lower fees, I'll make this real quick, but basically these the Canadian dollar version of these US ETFs are generally speaking just a shell. They're just a wrapper that contains the US dollar version. So when you're buying the Canadian dollars, Vanguard, BMO, BlackRock, whatever, they're doing the work to convert your Canadian dollars into US dollars and buy the US dollar version of the ETF. And so they take a fee, they take a cut for that, right? So for what I do, I'd rather cut out the middleman and buy the US dollar version directly. And I'd be able to cut down the fees by 2.5 times, 3 times. Obviously, the fees are already low to begin with. I know, for example, VFE, the Canadian dollar version, has an MER of 0.09%, but VOO, the US dollar version, is 0.03. They're both very low, but still, it's 3 times cheaper. So especially as your portfolio gets larger and larger, that difference in fees can start to add up. And I don't mind doing the extra work to convert to US dollars and save some money on those fees. But the biggest advantage is the tax efficiency. If you're buying a Canadian dollar ETF that contains US stocks, all of the dividends you'll be receiving, you will be paying a 50% withholding tax on those dividends. And it's out of your hands. You can't avoid it because the fund provider, Vanguard, BMO, they pay that withholding tax right off the bat before the money even comes to you, right? Instead, I like to buy the US dollar version of those ETFs like VOO, like SPY. And by doing so, and by holding those in an RRSP, I'm able to avoid cutting that 15% cut on those dividends. So I'm able to receive the full dividend amount, and I get all the tax sheltered benefits of using an RSP to begin with. Again, this benefit only really manifests itself if you're using an RSP. If you're using a TFSA, an FHSA, an RESP, you don't get to enjoy that 15% dividend tax benefit. But if you are using an RSP and it makes sense for you and your retirement plan and your tax situation, I suggest going for the US dollar route to get a slightly higher dividend yield and reduce those management fees. I know my answer was a little bit long, but basically that's the main crux of my philosophy. I want to customize my portfolio and I want to optimize the taxes and minimize the fees as much as I can. So that's why I prefer buying the underlying ETFs.
Awesome. Thank you, Adrian. Does anybody else want to jump in on that type of investing? We're good?
Nothing to add. No, you nailed it, Adrian. I think it's just displaying, like you said, right off the bat, what you're prioritizing, right? There's a spectrum there and you nailed it.
Awesome. And Adrian, I'm curious. So you said you decided that you don't want to do the weights that ZEQT does. And I've noticed among the other providers like iShares, Vanguard, they all have pretty similar weights in terms of their allocation between US versus Canada versus international developed versus international emerging markets. What made you settle on that different allocation, those different weights? How did you come up with that number? Can you speak to that a bit?
Sure. For me, asset allocation is a bit more of an art form than a science. There's definitely general principles and rules to follow, but at the end of the day, personal finance is personal. You really have to sit down and do a self-reflection on what your retirement goals are, what's your time frame, what's your risk tolerance, are there certain sectors you want to double down and concentrate on? Are there certain sectors you want to avoid? And that's a really personal question. For me, for the first couple of years of my life, I actually didn't have very much international exposure. I was basically 50% Canadian, 50% US. And that was from day one, basically. Probably about 5 or 6 years ago, I realized that, you know what, as much as I love the US market and the Canadian market, I am missing out on those emerging markets. I am missing out on those other powerful, more established markets in Asia, in Europe. But we've seen in the past decade, huge growth in those emerging markets like India, Brazil, Taiwan. And I didn't get to benefit from that, right? All of my companies were Canadian companies, US companies. So I really made a decision that I want to have some skin in the game and put some money into those international markets. But I still wanted the majority Canada, US. That's how I landed on that 40-40-20 split. It's really just a number that I'm comfortable with. It's easy to remember. And that allocation might change as my goals change and as I get older. But for now, I've been comfortable with that. And it's been working well so far.
All right, awesome. And yeah, I'll touch on it too, because buying the underlying ETFs, that is where the overwhelming majority of my portfolio is as well. So I'll touch base on that as to why I picked those particular ones. But I would say Adrian pretty much covered it. Again, the lower fees you can get by doing things to this level, by being willing to rebalance the investments yourself, you are gonna be saving some there. And then the tax efficiency is a really big component as well for myself. In Canada specifically, different types of ETFs, depending on the geography and type, they get taxed differently depending on which account they are in. So for example, just to give you again a real life example, when it comes to things, once your RSP and TFSA are maxed out, then you start investing in your non-registered account, also known as your taxable account. And so once you get to that level, there's some optimizations that you can start doing. So for example, in a taxable account, what's typically the most efficient is Canadian equities, because we get the dividend tax credit here in Canada. And so you can actually really benefit by having your Canadian equities in the taxable account. In the RSP, it's basically the US equity. So if you're holding US listed equities, that's a big caveat. It can't just be like a Canadian listed US equity ETF. It has to be a US listed. So that gets more complicated because now you're dealing with US currency. You have to know how to convert that cheaply using like something like Norbert's Gambit, which is what I do. So this is more, you go down that rabbit hole once your portfolio gets larger and you're like, all right, I want to optimize to this higher level and I don't mind the increased complexity and I don't mind the extra headspace, I'm ready to do this. But if you really want to optimize things to the extreme, typically that's how you do it. So for example, in the RRSP, almost all my US holdings are in my RRSP in a US listed one. Like, so I'll use VTI for that purpose, and I'll use Nordberg's Gambit to very cheaply convert that currency. And this way I'm able to avoid the withholding tax. And then for international ETFs, I tend to have those in the TFSA. And also things kind of change depending on how the markets shift. So for example, like if I have space in my TFSA and I'm already overweight or at my weight in the international ETFs, but I'm underweight in US, okay, then I'll buy US in my TFSA because I want to get back to the weights. Another kind of big tax optimization, I would say, and also just from a kind of returns optimization too, is when it comes to the TFSA. So as much as I love asset allocation ETFs, some asset allocation ETFs have a bond component to them. In fact, most of them do. So far, we've been talking about ZEQT, which is an all equity ETF. So all equity ETF, which is 100% stock. So that I would argue is a very good fit for the TFSA. But a lot of other asset allocation ETFs, they have a bond component. And so if you buy something like that, like a ZBAL, for example, and you put that in your TFSA, now you've basically got a portion of your portfolio is bonds within the TFSA. And I would argue that for your TFSA, my personal suggestion would be you don't want bonds in your TFSA because the TFSA, your growth is going to be tax-free, your dividends are going to be tax-free. And so you want the investments that have the highest projected returns, the highest expected returns. You want those in your TFSA because when those grow, you're going to be able to take them out tax-free. Whereas bonds have a lower long-term expected return compared to stocks. And so, for example, in your TFSA, you could do something like ZEQT, which is all equity. But if you're like, hey, I don't feel comfortable my whole portfolio being 100% equities. That's too volatile for me. I'm going to get anxiety. I get that. And that's probably most people. But so okay, so why don't you have 100% equity in your TFSA, but then in your RRSP, then there you could do something like ZEG, which is a bond ETF. You could have some there. Or you do a more balanced asset allocation ETF like ZBAL, right? Or ZGROW, something of that nature, right? And so this way, you're able to actually still, in a way, optimize using asset allocation ETFs. But if you're buying the underlying ones, then you're taking that up an even higher notch, right? Where now you're doing lower cost and you're fine-tuning by individual accounts. But again, that does take quite a bit of work. And this gets into the next question I had for you guys, which is, what are the negatives of going with this approach of buying the underlying ETFs? And I think we've already touched on it a fair bit. As you can probably tell just by me speaking, the complexity is clearly much higher than asset allocation ETFs. So that's something you have to be willing to take on. My big take on it as well is the rebalancing. So when I speak to different Canadians about this, you get a sense of how comfortable are they going to be staring at a spreadsheet and rebalancing those investments? Do you feel comfortable doing math in a spreadsheet and calculating this on top of raising your kids, on top of your job, top of trying to grow your career? And so again, you have to ask yourself, is that something that I'm willing to take on for that extra bit of efficiency? And usually I would argue buying the underlying ETFs isn't typically worth your time unless your portfolio is getting higher. So if your portfolio is already in the hundreds of thousands of dollars, then okay, maybe start going down that rabbit hole and see if it's right for you. And you may decide, you may be like Brendan, where you're like, hey, you know what? My portfolio is getting large, but I don't want to focus my energy there. I'd rather spend time on my family and growing my business because I can get a better return on investment growing my business than doing all these fine-tuning things that Cornell and Adrian are doing. So it's a personal preference thing. And again, I just think what I'm trying to do here is give you guys a menu of saying, here's the pros and cons of these different styles. And now that by being aware of this, you can make the decision that's right for you. And now a quick message from one of our sponsors.
It's the small things that make us Canadian. At BMO ETFs, all of our tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we know how to build solutions for the Canadian investor. So the next time you invest in ETFs, consider a Z instead. Visit BMOETFs.com for more.
Are you approaching retirement and wondering how to turn your hard-earned savings into an income stream? Introducing Sun Life's My Retirement Income Solution. This is available for those who have or have ever in the past had a Sun Life group savings plan through your employer. This solution is created for those who are nearing or in retirement and want to receive income tailored to a target age. How My Retirement Income works is that you pick a target age you want your money to last until, such as age 85, 90, 95, or 100, and then the solution offers a unique blend of income and growth potential to help your money last until your chosen target age. This automated process eliminates the need for repeated reassessment, and with this solution, your payments will be deposited directly into your bank account while still having the opportunity for your investments to grow. It provides flexibility, allowing you to have access to your money at any time without fees or penalties, along with an easy transfer to leave a legacy for your loved ones. Sun Life's licensed retirement consultants are ready to guide you through the process. To learn more about if Sun Life My Retirement Income is right for you, visit buildwealthcanada.ca/myRetirementIncome, all one word, to schedule an appointment with a Sun Life retirement consultant today. That's buildwealthcanada.ca/myRetirementIncome. And now back to the show. Do you guys have anything to add in terms of the negatives of going, because Adrian, I think, did a great job outlining the benefits of it, of buying these underlying ETFs. Are there any other negatives you guys see? Anything else you want to comment on?
Personally, I just think that you guys, between you and Adrian, you guys have covered off pretty much everything you need to know about that choice.
Awesome. Thank you. I see Brendan giving a thumbs up. So I think, we'll keep going in that case.
Yeah, if I could just chime in real quick. I think there's a lot of pros for sure. You guys covered the pros to death, right? I think simplicity, it's easy, no babysitting, automatic diversification throughout the world. So I think that's all great. I think it's great for beginners as well to just start with these instead of just picking and choosing your own stocks. I've talked to over 1,000 people, Canadians and Americans, and most people have played the stock picking game have not done well. Some have done well for sure if they pick the right stocks, but that's always a small minority. So starting with these, yes, it's a little bit more boring. You'll get more average returns, but at least you'll have a safer ride. My personal opinion, though, on these is that I think it's over diversification. So the more I go throughout my investing journey, the more I think about things is the $1 million question I always ask myself now, and I would encourage everyone listening to ask themselves as well, is the thing I'm investing in, whether it's a ZEQT or whatever it is does it beat the S&P 500 and does it have a chance of being it in the future? And most of the time, the answer is no. So I think that sometimes people need to be careful of over diversifying as well, because the best stocks, the best companies, the best businesses in the world, the best economy in the world is the US. And the most basic way to invest in this economy is the S&P 500. Everyone knows what it is. It's the most well-known, well-renowned index of all time that, yes, focuses only on the US. So I hear the argument, you're just focusing on the US, you're ignoring Canada and you're ignoring emerging markets in Europe. But my argument is if you actually look at the numbers, none of them beat the S&P 500 over time. And number two, a lot of the companies in the S&P, for example, 40% of the revenues of those companies are international revenues. So yes, they're domiciled in the US. Apple, Microsoft, Amazon, all those big guys, they have exposures all around the world. So I think starting with an asset allocation ETF can never be wrong. But I also think that just going with the S&P 500 performance-wise, and I'll show some graphs and numbers later on, in my personal opinion, is a good choice as well.
Yeah, that's a very interesting perspective. I know I do a lot of reading as well of people in the the financial independence, retire early space in the US. And a lot of them, or definitely there's quite a few of them that, to your point, Adriano, will just say, I'm okay just buying the US market as a whole. So like I mentioned VTI, for example, they'll just say, I'm okay that being 100% of the equities in my portfolio. And their argument is similar to yours, where these companies like the Apples of the world, the Microsofts of the world, these are international companies. So the argument is you are, in a sense, diversifying internationally because those companies have businesses all over the world and they're so dominant. But then you'll also hear that other side of the argument where, like people like Ben Felix, for example, he mentions this quite a bit in his research, where there have been companies where a country is doing well economically, their stock market's doing good, and then they falter very heavily. Like Japan is like one example, for instance, right? And so that they're the dominant player for now, but are they going to be in the future? And so now you're making a bet of, do I feel the US is going to continue to be the dominant player for the foreseeable future? Yes or no? And then I think that's where it becomes, or are they already overpriced? Some people argue that, right? So you have to decide for yourself where you want your chips, in a sense, right?
Yeah, I hear that argument all the time, especially in the US. Should I buy VOO, VOO, which is in Canada, it's VFV? Should I go with VT instead or VTI? So VO is the S&P 500. VTI is the overall US market. So it has the S&P 500, but small caps, everything. And then VT is the whole world, which is equivalent to a ZEQT. So my argument with that is that's fine. Maybe you're right. And listen, if it do whatever makes you feel most comfortable is what I always tell people. But me personally, I feel the S&P 500 is king because I'm not investing in the US or the US dollar. I feel I'm investing in those businesses. That's what you're really investing in. So that argument to me doesn't make much sense. And if you just look at the numbers, if you just do the S&P 500 versus the world or versus emerging markets versus Europe versus Canada in the last however amount of years, the S&P 500 is always on top by a lot, especially lately. So the numbers don't lie, but if it makes you feel better to get the whole world, that's fine. But I strongly feel like just the S&P 500, if you just want to get that and that's it, that's more than enough diversification, I would say.
Awesome. Yeah, thanks for sharing your perspective on that. Yeah, it is interesting how for someone like yourself, you are totally okay making that bet with your money. And then for sure, there's other people in the world where they hear that and they think having all my money in one country, that's crazy. What if, especially, the US election, new president comes in. What if they wreck everything? So some people, I imagine, would have sleepless nights over being 100% invested in just one country. Whereas others are like, hey, look what's been happening. I'm still confident in their ability. Like you said, I'm investing in the companies, not that country per se. They're internationally diversified anyway. So yeah, it's a very interesting internal debate that I'm sure a lot of Canadians have. I wanted to move things on to Mark to talk about fixed income, which is a very key piece of someone's portfolio. One thing that I forgot to mention though is in the previous question, I was supposed to talk about too, like what ETFs do I actually buy for my portfolio, which I did not mention, I don't think, in my answer, but I'm not going to spend like 20 minutes talking about that now. So I do have a guide on my site that you can get for free. And there I basically list all the ETFs that I personally buy, what account I put them in for the greatest tax efficiency. So it's kind of my analysis, and it's a live Google Doc. So basically as things change, they don't change often, but as things change, I do update it. So you always can see it. So if you do want to get that, it's just buildwealthcanada.ca/guide. That's all it is. So you can go there or email me or something if you're having trouble finding it, and I can send it to you. But yeah, awesome. So let's move it on to Mark. So Mark, so far our conversation has been dominated a bit by equities, or a lot by equities. In other words, the stock portion of the portfolio. But of course, fixed income is also something that most investors find to be a good fit, especially since not everyone can stomach having a 100% equity portfolio and dealing with those occasional 30%, 40% drops and just riding those out and not panic selling. You have some focus on fixed income in your portfolio, which can help reduce that volatility. Can you take us through your thought process on having these types of investments, along with which ones you like to buy and why?
Yeah, sure. Would be happy to do that. And like you say, today's conversation has revolved mostly around equities. And in fact, most of the news you read out there today revolve around equities, just because we're in such a strong bull market. That tends to be the way it goes. I have always believed, I believe today, that having some fixed income in your portfolio provides a balance. It provides a hedge, and it complements the equity portion. And it's not a matter of if, it's a matter of when we have the next big event in the market. So whether it's a market crash, if the Fed lowers interest rates to combat that, there will be a flight to safety, no question. That always happens. That's when fixed income can benefit. And over the last number of years, we've seen fixed income not really do what it's supposed to have done. It hasn't acted as non-correlated as it should have historically done to equity. So it's really out of favor right now. And I certainly understand that. We have to remember that not all fixed income is the same. And we tend to talk about fixed income as one big thing. And that would be like saying, let's just talk about stocks. And most of us will know that there are all different types of stocks that you can invest in, and they all have different characteristics. And I think when it comes to fixed income, you can think of government bonds versus corporate bonds, or duration, short-term bonds, long-term bonds, Canadian, US, international, or even when you get into the junk bond category. And there are many more. They all serve different roles in a portfolio. So it's really important that you don't just think of fixed income as one thing, because it really should form part of most people's portfolio, in my opinion. For myself, I touched on this earlier, but I'm 62 years old. To me, my priorities of managing an account have shifted more towards protecting the downside than it has getting upside on it. I just need to balance the risk in the portfolio. And for a younger person, that might not even be a concern at all. I have always operated under my own sort of personal discipline. And so even though I might not feel like I want fixed income in the portfolio right now, I've been through enough of this roller coaster ride to know that there will come a day where it'll shine in there. So I think that's something that a lot of people might want to at least consider, is holding some fixed income. I also will add that it's not just the safety. Fixed income also adds a cash component to the portfolio. And we talked a little bit about covered call ETFs. And personally, the only two, and just for context, my portfolio is roughly about 85% right now invested in equity. So I do have most of my portfolio still in equities, but of the portion that I do have in fixed income, I've opted recently to switch over more to the longer term bond. So a couple of bond funds that I own, HBND, that's a Hamilton fund. It invests in TLT primarily, which is U.S. government treasury long-term bonds. It has a covered call overlay that provides extra cash flow, so the yields there are attractive. I also own HPYT, which is a harvest ETF, managed basically the same style. And I'm doing that mostly because of where we are in the economic cycle right now. We have seen interest rates, I'm saying, for example, the US 10-year bond right now, which is the closest one that I watch. We've seen that come down. Now we've seen it recently go back up again. It's acted a little bit counterintuitively recently, but some of the events I spoke of earlier, or just when we look at the longer term prospects for that bond yield, that I believe is still going to come down. When the yield comes down, the prices are going to go up on that. So to me, it's more of a strategic play on what I'm owning right now. But there have been times over the years where I've had shorter term bonds, where I've had higher yield bonds in the portfolio. Again, it's a whole nother podcast, I think, is how to manage the bond portion of your portfolio. But that sort of summarizes, Cornell, why I think that's certainly why I hold bonds in my portfolio, or fixed income, I'll say. And exactly, I think it's something that most of us should have a look at least. I don't know what your thoughts are on that, but.
Wonderful. Thank you, Mark. Adrian wanted to add something to here.
Yeah, Mark, if you don't, I have a bit of a personal question, if you don't mind sharing. So now that you are, I guess we call semi-retired, all your bond income, your fixed income, are you actually like living off it, like spending it, or are you still reinvesting it and still accumulating?
Yeah, my investments right now, I don't use to live off of. I do have some cash set aside. Again, that's probably controversial, because why would you have cash at all? But I've always felt that having some cash set aside is a good thing to have. So no, I don't. I just reinvest all my dividends at this point.
Sounds good. Does anybody have anything else to add on the fixed income discussion? Nope. Sounds good. So we can move forward. I've got a couple things to add, just to give some more tickers, some more resources as well for anybody that wants to learn more. Yeah. So when it comes to fixed income or bonds in general, one that I've seen recommended more than pretty much any other one in terms of bonds is ZAG, Z-A-G. And so that's one that I would say, obviously, do your own due research, do your own due diligence. But when I've seen kind of the different publications, published top ETFs, things of that nature, ZAG seems to be one that I've seen consistently mentioned in those. And so that is one that I've recommended, I know, in the past to friends and family. Now, the interesting thing I've noticed too with the bonds, like you mentioned, Mark, bonds have in general behaved a bit strangely, right? I remember in the not too distant past, there was a double-digit decline in bonds because of what happened with the interest rates. So I remember there was a lot of shocked retirees and fixed income investors who were saying, what's going on? Bonds are supposed to be the safe portion of my portfolio, yet they dropped more than 10%. What's going on? That doesn't sound safe to me. And so people started looking, I get this question a lot, looking at, okay, what are some, like you mentioned, what are some other alternatives for those that don't want to invest in the traditional bond ETF? What are some other options? And so I actually did an interview on this subject because I was curious myself, especially like in your case, I'm semi-retired as well. And so I do like to have a bit of that cash cushion. And then one begins to wonder, okay, I'm living off my portfolio. I want to have I like having most of my money in equities, and I do. But what about that safety portion? Let's have something there. And so there are certain ETFs that are specifically created for that short-term fixed income holding, where they do not fluctuate as much as some of these long-term bonds that we spoke of. Those are the ones that took a big hit when there was the big interest rate changes, because when you shorten the duration, it does not fluctuate as much with interest rates. And so there are a few ETFs I'll mention that can serve that purpose, or ones to at least look into if that's something that you think would be a good fit for you. So one is ZMMK and one is ZST. And I actually did an interview on those specific ETFs because, again, I was curious for my own portfolio. We see high interest savings accounts that banks offer, but then are there other options? Are there ETFs that do something similar, but can actually give us a higher interest rate? And it turns out that many cases there are actually. And definitely something worth going down, especially if you're going to be putting quite a bit of money into cash, especially if you're a retiree. Some retirees like to have that 2-year sort of cash buffer, right, in case there's a big hit to their equity portion of their portfolio. So again, it's I think a worthwhile rabbit hole to go down to see what are my options as a Canadian in the Canadian stock market. Maybe something is a good fit for me. So I created a link that will basically automatically forward you to that episode where I interviewed an expert on this specific subject. His name is Matt Montemurro, a very knowledgeable individual when it comes to this. I learned a ton from him about this. And so that episode, it's at buildwealthcanada.ca/short. So just buildwealthcanada.ca/short, as in short-term, safer type of investments. And so, yeah, hopefully that is helpful to you. Again, it's free. You can just listen to it, stream it. You don't have to sign up or anything. So hopefully you find that helpful.
Sorry, Kunal, to interrupt, but you mentioned ZMMK. I also use ZMMK, but not for my retirement. It's specifically for my short-term goals because it is such a short-term bond. So what I'm using it for is, one of my goals is I want to buy another rental property in the next 2, maybe 3 years. So that's such a short time horizon where I don't really feel comfortable investing the down payment in equities, in S&P 500. But I also don't want to just have it sitting there in a high interest savings account. Right now, high interest savings accounts, we're not really getting great savings rates there. With something like ZMMK, it's perfect for that 2 to 3 year time frame where I'm earning, I think now I'm earning like 4% in dividends on that. Dividends, it's really interest income. But the idea, like you mentioned, with something like ZMMK, it's not going to grow in value. It's designed to stay flat. I think it stays flat at around $50, but you're getting that monthly income. And it is significantly higher than I would get out of a savings account. However, the downside is it's not 100% guaranteed. I don't get that CDIC insurance, right? So if you're willing to take a slight non-zero amount of risk for a short-term money goal like I am, I think ZMMK is a great option.
Awesome. And now a quick intermission to tell you about an additional free resource that you may find helpful. I often get asked what I personally invest in and why. So to answer that, I created an in-depth guide to explain what specific investments my wife and I held and continue to hold as we moved through the accumulation phase, where the focus was to grow our investments as quickly as possible, and then transitioning to living off our investments in our early 30s when we hit our financial independence number, and the focus shifted to living off our investments in a sustainable fashion long-term so that we don't run out of money in our early retirement. These investments are literally where we have almost our entire net worth apart from our house, and is what we are living off right now. So I figure at the very least, you'll learn about some great investments to consider for your own portfolio. I explain why I pick those, and I do provide the names and ticker symbols of the specific investments so that you can look them up yourself. The guide is actually a live Google Doc that I continue to update as things change, so you can view it anytime to see what I'm currently holding and why. I get it that it can be super overwhelming with the thousands of ETFs and other investments to choose from for us Canadians, and so I hope this will make things easier and less stressful for you. You can access the live Google Doc at any time by signing up for free over at buildwealthcanada.ca/guide. That's buildwealthcanada.ca/guide. Enjoy, and now back to the show. Thanks for giving us your input. Mark, you had a comment as well, I think?
Yeah, just based on what your commentary a few minutes ago, Cornell, one of the things that you use the term, and quite correctly, you'll hear this a lot, when bonds drop in value, how safe is that? Or something to that effect. And when I look at the safety, you always look at the individual security, but I look at it from the portfolio perspective. So statistically, having that mix of bonds will make the portfolio safer over time. What they'll comment there. And also, when you look at the price of a bond, you might type in any ticker. and you look at the downward trajectory of those bonds, rarely do people look at the total return. And you always have to look at both of those. So the bonds, the price of the bond will drop when interest rates go up. That's just the way it works. But also you want to compare that with the total return. And it's usually a much more attractive number when you factor that in as well. Just a couple things to think about when you're out there having a look at the bond sector in general.
I'm really glad you mentioned that because you're right. It's like some of these ETFs, like Adrian was saying, the value of it actually is flat. So if you just Google that ticker, you're like, oh, this is a horrible investment. It never moves. I'm not growing my money at all. And it's, hold on, did you look at the yield number? Because that's the whole purpose of this particular ETF. So like you said, you do have to look at total return. Mark, do you have a favorite resource that you use to check the total return of ETFs? Because I've noticed in a lot of public websites online, if you just Google a ticker, it's going to show you the price of that ETF or price of that stock, which does not include dividends, does not include interest. What do you like to do? You have a go-to? I'll share the one I use, but I'd love to hear if you have one.
Oh, I do have a go-to. I use a platform called Koyfin. It's Koyfin. That's what I use for my charting. And it's very easy to look at price return and total return. So I have a template set up where I can quickly go and toggle those on or off. So that's what I use personally.
Okay, thanks. Is that a paid service or is that a free?
They have a free version. And then, of course, like most, they have, if you want more features, they have a paid version as well.
Okay, awesome.
Some different tiers.
Okay, sounds good. The one that I use is Morningstar CA. If you put in, and they're not paying me to say this, so I'm not affiliated with them. It's just when I used to run all the marketing for Key Money Saver magazine, and they also own 5i Research as part of that. And I remember speaking to the people that analyze stocks professionally, and I would say, what do you guys use to see total returns? Because you do this as your day-to-day job. And they're all like, oh yeah, we just go on Morningstar. We just go on Morningstar Canada. So ever since then, that's to get total returns. Because you just go in there, you put in the ticker, it can be like the ETF, and then you'll see the actual total return. And so that really, and I can't stress this enough, this really helps you compare apples to apples when you're comparing different ETFs, because you really do want those, just to get back to basics when it comes to the growth or how much you earn off an investment, right? There's the capital gains, the growth component, and then there's the interest or the dividend component, depending what you're investing in, right? So there's the income piece, and then there's the growth of the actual asset. You want the total return, which is those two added together. If you're just looking at one, if you're just looking at dividends, that's foolish because you might have 10% dividends, but your stock fell 50%. Okay, that's actually not, so you can't look at those in a vacuum, or vice versa. Oh, the stock went up, but the yield's been like horrible. You want to include both of those to get actually a holistic view of how it's been performing. So I just thought I'd mention that because I find that is a very easy mistake to fall into, where we just Google things, we see the price, we see the return they tell us, and it's, oh, that's the return. And, oh, hold on. Is there any income that's being generated? Anyways, I'll stop with the rant, but I thought that was a really valuable resource that I wish I knew about, that I wish I was taught in school. Adriano, thank you so much for being patient. Let's talk about your investing style now. I should have you on the podcast if you're up for it some other time, where it's, because I feel like you've been quiet, but I really want to hear about your FI story. I want to hear about how you invest.
I think a separate podcast is going to be pretty good, especially from what I'm going to tell you now. And my spiel here.
Sounds good.
If you're ready, I'm ready to go.
Let's do it. You know what I'll do is Adrian actually submitted some slides to me that he's going to be talking about.
Yeah, I'll tell you when to display them.
Sounds good. So I'll do the switch now. And I know there's going to be a lot of people listening just on audio. So Adriano, if you can,
I will describe as best I can.
Describe as best you can. That would be super appreciated as well. Okay, awesome. So give me 1 sec. I'm just going to do a flip now to share the screen. Okay, we're on slide 1. We're ready to go.
Okay, perfect. So I'm not going to look at the slides yet. I'll touch on them later, but you can leave it up if you want. So I'll just give you a brief on my investing style. We talked about asset allocation, ETFs, fixed income, things like that. So in terms of what I do, my style, it's an income-oriented style that does not ignore performance or returns. So basically, I want the best of both worlds. I want yield, right? I want consistent income, but I want performance in line with the overall stock market, with equities, aka the S&P 500. So what's the best way to get performance with the overall market, right? It's index-based ETFs, right? And things like VFV, et cetera. There's index-based ETFs that have the world, like we discussed, like a ZEQT, Canadian market, US market. I personally think, and the numbers don't lie, the US is the best, right? The best companies, the best economy, the USA. So my two favorite, I would say, and my go-to indexes are going to be the S&P 500 and the NASDAQ 100, which are good representations of the overall US market. When people say the market, you hear the market, they're typically referring to the S&P 500, which is 500 of the best stocks in the US, domiciled in the US, but that have international revenues and these are big cap stocks. These are the big boys, right? Apple, Microsoft, et cetera, et cetera. So personally, I don't want any international exposure because it always underperforms the S&P 500 over the long term, including Canada, right? So we talked a lot about ZEQT, Z or Z, whatever, has about 50% US, the rest in Canada and the rest of the world. So my argument is why bother? The S&P 500 is already diversified. There's revenue coming from international. And the S&P 500, if you look at it, has beaten all asset allocation ETFs. And in my opinion, it will continue to do so long term. So I don't really see a point. If it makes you feel better, the math doesn't lie. So that's really what I like to invest in terms of the assets. How do I get my yield and income now? The $1 million question, right? So retirees, people who want to supplement their income, about to retire, what does everyone need? Income. I get it with covered calls. So what are covered calls? Well, covered calls is a very basic, boring option strategy that existed in the 60s. And I'm not going to go into a whole thing of explaining it. There's a million videos you could watch, including on my channel. But the gist of it is you're giving up a portion of your upside. So let's say you invest in the S&P 500 or a stock or anything, and you're doing a covered call strategy on that asset. You're giving up some of the upside for income, for those premiums. So this has a two-prong effect. One, you're getting income. And number two, you're actually lowering your risk. You're lowering your volatility. So for example, if you go on BMO's website, they have a bunch of covered call ETFs. They're still the number one covered call ETF provider in Canada. In the fund benefits, you'll always see something like lowers volatility. So why is that? Because risk and volatility, as you guys know, has to do with the downside. With the amount it could go down, right? So when you're writing covered calls, you're giving up some of that upside, but you're cushioning the downside with those premiums. So in a bad market, when market goes down or the market is flat and there is no upside, right? Those premiums are basically free money. They're cushioning the downside of your assets going down, right? So I'm looking for good performance and consistent income. Enter combining these two factors together, an S&P 500 covered call ETF or a NASDAQ 100 covered call ETF. And by the way, there's even a TSX 60 covered call ETF. There's ZEQT. There's even Global X has a version that is a covered call version of that style of ETF where you get the whole world. So you could write covered calls on pretty much anything. So typically, a covered call ETF is going to have lower volatility, but also lower performance, lower return over the long term to the corresponding index fund, right? So S&P 500 with covered calls. The one with the covered calls is typically going to have a little bit lower performance over time because you're giving up growth with a covered call strategy, and the market goes up more than it goes down. That's basically it. So to solve that problem, to close that performance gap, a brand new fund, these funds have been out for just a couple of years now, and these make up the majority of my personal portfolio. They add a little bit of leverage to the strategy. S&P 500 covered call ETF with 25% leverage. So leverage is a scary word, right? It's money that you borrow to invest more in your assets. So what I will say on the leverage portion, and by the way, guys, stop me at any time if you want explanation or something's not clear, but just to go over the leverage. First of all, it's not a lot of leverage. It's only 25%. Number two, it's hands-off leverage. This is leverage that the fund manager is managing for you. They're borrowing the money. So no margin calls or anything like that. It's not you going in your Quest trade or your Wealthsimple and borrowing money. No, it's already integrated in the fund. Fund managers have the best borrowing rate, much better than you and I could get. And what this does, it increases the long-term performance over time and also your yield. Yes, it does increase the volatility or the risk by 25%, but don't forget covered calls lowers it. So the actual risk of owning, for example, an S&P 500 covered call ETF with 25% leverage, the risk and volatility is fairly similar to just owning the S&P 500. But You could also get a non-leveraged version if you're more of a beginner. This style, my style of investing, it solves many problems retirees have. It's one of the safest, if not the safest way to invest in stocks. Easy, diversification, top companies, automatic rebalancing, no babysitting, no time wasted, right? You just buy an S&P 500 index style fund. Covered calls lowers your risk versus just owning the underlying asset outright, like a corresponding VFV or VOO. You get consistent high monthly income even during market crashes, during volatility, because covered call premiums are basically eternal, right? And the funny thing is that covered call strategies actually thrive during volatility and during the bad times, because covered call premiums, the premiums you get for giving up that upside, actually is higher. It's based on volatility. So when there's higher volatility, those premiums are higher. So you'll actually sometimes see covered call funds give out more income during the bad times while the assets are going down. So that's very interesting. Also, you never have to sell anything, right? It's super easy during a bad year or flash crash because, for example, compare it to the investor who just holds the S&P 500, who's drawing down their money, right? Every month or every quarter. I call it the drawdown problem. What if you got to sell during a bad time, during a flash crash? With this strategy, you never have to sell your units because you're getting that consistent monthly income. Also, it's tax efficient, right? Because covered call premiums, option premiums in Canada is actually classified as capital gains. So if you get fixed income, bonds, REITs, they tend to have mostly a lot of regular income. So capital gains are taxed 50% better than regular income, as we know. And then the last thing is it has similar performance to the underlying asset, to the index itself. So you're not sacrificing a huge amount of return. You're not sacrificing that return by having a percentage in fixed income or gold or REITs. And now we're going to take a look at the charts that's actually going to prove that point. So the first chart, like you see here, this is basically a bunch of asset classes over the last 10 years. And you see the fixed income is circled. And this is all kinds of different fixed income, right? You got emerging market bonds and high yield senior loans, aggregate, T-bill, everything, the whole fixed income universe. You have commodities, you have gold, you even have emerging stocks, there, EM stocks. What's at the top? What beats everything? The S&P 500. It's not even close. If you go to the next slide, if you don't mind.
Sure.
This is, so you might say, well, that Adrian, that's only the last 10 years. How about since 1802? So this is a graph that I took off a Harvest ETF presentation. And you could see clearly that everything versus stocks versus equities is not that great, right? Gold, obviously the dollar loses value, bills, bonds. And this is till 2021. If you actually do 22, 23, 24, bonds would be much, much lower. So this just proves that over a long period of time, stocks are king, equities are king. And this is not even, I don't think this is the S&P 500. I think this is just the whole overall world stock market. But you could see the big difference in performance, right? Next slide, if you don't mind. This is the S&P 500 returns every year for the last 40 years. So the average return is over 11%. And you could see that, yes, there could be some red years, some negative years, right? The 2000 internet stock market crash. There's, of course, 2008, which I believe is the biggest single year drop, minus 37. A little drop in 2018, minus 18 in 2022. But what you quickly realize is that for most of the time, the S&P 500 is green. It's great. It goes up over time. So in my opinion, anyone should be able to really stomach the volatility of the S&P 500. In my opinion, it's the easiest, least risky, lowest volatile way to invest in the overall stock market. If you go to an amusement park and it's called the stock market, the S&P 500 is going to be like the kiddie ride with the teacups that the parents go with their kids. It's not that volatile, to be honest with you. And again, if you're adding covered calls to something, you're lowering the volatility. So my argument is, the question I always have to ask myself now, why get anything else? Why not just hold this forever for your whole portfolio? And if you go to the next one, I did some comparisons with, I think, some of the funds we talked about. So you have ZAG, You have Zcon, which is the BMO conservative ETF, which is an asset allocation ETF that does 60% in fixed income, 40 in equities. And I also put REITs in there. I thought we would talk more about REITs, but ZRE is in there versus the S&P 500 index fund, right? ZSP. And you can see the performance discrepancy. It's not even close. If you look at ZAG, last 10 years, 1.85% a year. That's a nightmare. Let's be honest, guys. It's terrible performance. If you look at the S&P 500, the numbers speak for themselves, right? This is the last 10 years. So you could clearly see the performance discrepancy. So again, I ask, why bother with anything else? Next slide. Some more comparison. So this is more asset allocation ETF. So you have ZBAL, which is 60% equity, 40 bonds. ZGRO is 80% equity, 20 bonds. And then you have XEQT, which is pretty much very similar, if not identical, to the famous ZEQT, which we've been talking about. The reason I didn't put ZEQT is because it hasn't been out long. XEQT has been out for at least 5 years. And you could see, again, the comparison, it goes up as we get less fixed income and more in equities. And of course, the king is still the S&P 500, right? By a long shot. So 5 year of ZBAL, I'm sorry, I forgot that the audience can't hear, but I'll give some returns here. So 1 year for ZBAL, 15.89%. 1 year for ZGRO, 20.49%. So a lot more because it has more equity. XEQT, all equity. So of course, it's going to be even better. 24.67% return. S&P 500, 35%. So these are big. It's not like it's a 1 or 2% difference, right? These are big discrepancies in performance. And last but not least, the last one. So this last slide, everyone, this is where I'm actually showing how some S&P 500 covered call ETFs are performing versus an XEQT or the S&P 500 itself. In this case, I'm using ZSP, which is basically the same as VFV, right? From Vanguard in Canada. So the first ETF, the Evolve S&P 500 Enhanced Yield ETFs, the stock symbol is ESPX.B. So this one is, there's ESPX and there's ESPX.B. The only difference is the .B does not hedge the Canadian currency. That's all it means. So that's why I got to use that one when comparing to ZSP because it's not a Canadian currency hedged S&P 500 ETF. But anyway, 1 year performance is 33.38 versus the S&P 500, which is 35. So you could see that it's pretty close. It's in line, but this one has no leverage, by the way. So it's not a volatile ETF at all. It actually has less volatility than actually owning just the S&P 500 because there's no leverage, but there's covered calls. So you are sacrificing a little bit of performance versus just owning the S&P 500, but you could see how close it is, how close it matches the actual performance of the asset, the underlying asset, which in this case is the S&P 500. The next ETF is one that I personally own. It's one of my core positions. It's the Global X Enhanced S&P 500 covered call ETF, stock symbol USCL. So this is basically the S&P 500 with covered calls and 25% leverage. And the 1 year return, unfortunately, we don't have 3 year, 5 year because the ETF has not been out that long. But you could see the 1 year return is 38%, 38.44 versus the actual S&P 500, 35.25. So it's actually beating, a covered call ETF is actually beating the S&P 500. And that's thanks to that leverage. So that goes back to what I was saying. You're adding a bit of that leverage. You're closing that performance gap with the actual S&P 500 on its own. So these are two great options. If you're an income investor, you want income, but you want to stay invested in the S&P 500. You don't want to sell anything. You want a monthly income. These are two great options. If you're a bit scared of the leverage, you don't want that added volatility, you could go with an ESPX, for example. Or if you're okay with that leverage like I am, there's USCL, which gives you about 12% yield and similar, if not better, performance right now to the S&P 500. And you could see at the end, I put ZEQT, XEQT there, which is same thing as ZEQT practically, and the S&P 500. And all the S&P 500 covered call ETFs are actually outperforming it. So that's my spiel. I'm basically trying to back up what I'm saying with numbers here. So again, my overall question is, why bother getting anything else? Why bother with the fixed income and the international when the S&P 500 is king? And if you have the problem that you're a retiree, you need cash flow, the covered call version solves all those problems for you. You get income, you get great return as well, and you don't have to diversify to other asset classes that always underperform and that are not as tax efficient as well, the S&P 500. Any questions?
I had one. So one
Shoot.
of the things that jumped out at me was when looking
Yeah.
at your charts, it's showing just the 1 year return. And by 1 year, I assume here you meant just over the past year. Those are the
It's
returns.
the 1 year
right?
return because they haven't been out for 3 years yet, the S&P 500 ones. This is just to show that the return is going to be very similar, if not very in line with the actual asset.
Okay. Yeah, because the one thing that jumps out at me is like when I'm looking at investments, the 1 year return is not that important to me personally. What I care about is
agree.
the 10-year, 20, 30-year return, that kind of. So when these ETFs got released, how did you get past that anxiousness of putting money into these ETFs when
Great question.
you don't really know how you don't have the 10-year history of that ETF. You just have 1 year history. And then the US obviously had a really good year, like super year, right? So it's like, how do you know these are going to perform that well when we get the next 2008, for example?
That's a great question. I get it all the time. The answer is simple. If you understand what you're investing in, you already know that it's going to do more or less what the S&P 500 does. So the S&P 500 is definitely not new. Covered calls is definitely not new. So if you know how those two things work, you know exactly how it's going to behave in the next 10 years. It's going to behave very similarly to the S&P, to the underlying asset, right? This is where some fund managers have different strategies. But with time, we could do this podcast in 10 years and I'll have the 10-year data. But my prediction, I'll have no hair and I'll be old and have white hair and whatever. But if I'm still here, we'll do it. But my prediction is going to be still like it is now, the 1 year, it's going to be very similar. So if you're investing in an S&P 500 covered call ETF, you are investing in the S&P 500, period. That is the asset that you're holding. They're just doing a covered call strategy on it. So you're getting that monthly income. You're giving up some of the upside for monthly income, but the corresponding asset is still the S&P 500. Just like Mark said, he invested in H bond that invests in TLT with covered calls. It's still going to follow TLT. Just because the ETF doesn't have a 10-year track record, it doesn't really matter because you know how it's going to perform, the behavior. It's like if someone else launches an S&P 500 ETF, that's just the S&P 500. It has no 10-year track record, yes, but you know what's going to do what the S&P 500 does, right? So it's the same story here. So you're still investing in the asset, right? So Mark is still investing in that TLT. If you actually look at H bond, if you look at the holdings, most of it's TLT. They're just writing covered calls on TLT. So it's the same thing for any covered call ETF. You're still investing in that asset. That makes sense?
Yep. Hey, Adriano, I've got a question to jump in here. So I was very curious on the last slide when you were talking about that really new, recent 25% leveraged Global X ETF, right?
Yes, but
so again, we don't have a track record. We can't really see how an ETF like that with 25% leverage would perform in a market downturn. But do you have any numbers or of similar comparables that have 25% leverage and how they performed during 2022, during 2020, those kind of numbers?
So the first ETF, so with covered call ETFs in general, a lot of them came out in 2011, 2012, but the ones with 25% leverage, I believe the first one came out in 2021. So we do have a bad year. 2022 wasn't great. So we saw how they performed. They perform more or less like the assets inside. So why is that the case? Why is that always the case? Because covered calls lowers your volatility, it cushions your downside, but the 25% leverage increases it. So it balances out in a way. That's why, for example, if you go on Hamilton website, you look at the ETF HYLD, which is another primary holding, which is basically the S&P 500 style with covered calls and 25% leverage. It says right there on their website, similar volatility to the S&P 500, to the index. So we don't have a crazy amount of data in terms of bad years because they only came out in 2021. We have 2022 and the ETFs pretty much perform very much in line with the underlying assets. So the behavior is going to be fairly similar. If the S&P 500 goes down 20%, your fund is going to go down 20% plus 25%, a little bit more. But that income, that big income that month balances it out because that's where the cushion is. So it's going to be very similar. My prediction is, my well-educated guess is, it's going to be very similar to the asset.
All right. Does anybody else have anything to add? Oh, Adrian?
Sorry, one more. I've got one more, a bit more of a personal question. Adrian, from what I understand of you and your journey, I understand that you and your wife already built up a significant portfolio when you started to switch gears and go this more income-oriented strategy. If you could go back in time to when you were in the growth phase, when you're still building your portfolio from modest beginnings, would you do things differently? Would you still recommend this strategy? Or is this more for people who already have a sizable portfolio?
That's the beauty of it. You could do either way in both scenarios because like I just showed you, my journey was very special. I was a complete noob. I wasn't an investor at the beginning. So I had like single stocks and I was swing trading. I only really started like doing this kind of style of investing or discovering covered call ETFs 2018, 2019. And like I mentioned, a lot of these great ones now, it's only a few years they've been out. So we've been really spoiled, especially in Canada, with people like Harvest and Hamilton and Global X coming out with a lot of the index-based ones. These are all relatively new in the last couple of years. So if I would start now and I was in my accumulation phase, I personally would still go with, for example, a USCL or an HYLD, an S&P 500 with covered calls and 25% leverage and just put it on drip. Just put it on drip. Because we saw the performance is very similar, if not even a little bit better so far with the leverage ones. And I showed the S&P 500, but there's also the NASDAQ one. There's a bunch of other ones, and they're all very similar to the NASDAQ one to QQQ, the S&P to the SPY or VOO. You could actually still buy these instead of the index funds. But buying the index funds, of course, is still great. It's still a great option. But you could still do the same thing. You could start with these, put them on drip. And when you turn the drip on, you're basically turning your income investment into a growth investment. Because I feel, guys, let me know what you guys think about this as well. I think growth, the term growth in investing is very misunderstood. People associate it a lot with the growth of the stock price or the growth of the chart. Whereas I feel you should be focusing on the growth of your investment, the growth of your money, of your wealth, right? Which is all based on returns and performance. So yes, you could do it. You could just buy index funds. You could buy an S&P 500 and then a lot of people do that. And then they just switch over to the covered call versions, for example. But myself personally, I just love seeing that income come in every month. I just love it. You could do whatever you want with it. And if you're in a growth phase, if you're in the middle of your career, you could just turn the drip on and it's the equivalent of just holding the index fund. So let me know what do you guys think about the term growth? Because I feel people should be looking at the growth of their investment, not the stock price, right? Because if you're looking at the stock price and you guys already talked about it, you look at it in Google, it seems flat, but that doesn't show the income or the yield coming in. What do you guys think?
Yeah, for sure. So what we were talking about before, right? Mark and I mentioned those two different resources where you actually are looking at sources that show you the total return, which is the income and the growth or capital loss to actually be able to compare. Because yeah, those are the two key components. You don't only want to be looking at one component. But yeah, exactly. I'm with you on the whole, you always want to be looking at total returns. I don't see any reason. Why would you only look at half of the thing, right? So I don't know. Does anybody have anything else to add?
Just very quickly, this concept of is the new funds. I'll just address that very briefly here, Cornell, if I might. If you have an ETF that comes out or any company that is a new concept, entirely different from an established index, for example, yeah, you can say the track record matters a lot. But when you have, as Adriano said, something that comes out and essentially their whole objective is to mirror the S&P 500 or the TSX or whatever the index is, that is pretty predictable. And what came to my mind as Adriano was talking is if you go out and buy a new pot and a new bag of pasta, if you boil that water and put the pasta in, it's a new pot and a new bag of pasta. What's going to happen? Because every time the pot in, you don't have to guess, oh, this is a new pot, so maybe it's not going to work. You can be pretty comfortable that it will. Now, when you start putting overlays like covered calls, when you start putting the leverage aspect, yes, you have to look maybe a little deeper into aspects like that. But for the most part, you always hear it's a brand new ETF. How do you know how they're going to perform? If they're tracking the index, they're going to perform like the index. Pretty simple.
Yeah. Yeah. I wish they've been out for 5-10 years so we could see. USCL is going to be 3 years this year, I believe, but it's more or less going to be in line with the underlying assets. I get the question all the time, are covered calls risky? What's the risk? Covered calls is just, think of it like a little spice that you're putting on the pasta. It's still pasta, right? You're actually, not many people know this, like I discussed, you're actually lowering yours. When you're putting a covered call on something, you're actually lowering your volatility a little bit because you're sacrificing upsides for more downside protection. Volatility risk is all about the downside, right? So what's the risk of an S&P 500 covered call ETF? It's the S&P 500. You could do covered calls on anything. What's the risk of just Tesla with the just Tesla with covered calls or just Nvidia with covered calls? Your risk is still associated with Tesla, with Nvidia. Right now, we even have a MicroStrategy covered call ETF. Why does this give such enormous, insane amount of yield? Because it's a very volatile stock and covered call premiums are based on volatility. So the higher the volatility of the stock is or the asset is, the higher the income potential could be. So it actually lowers risk. It doesn't increase risk. The risk is still the same. To determine your risk, you got to look at the asset. That's your number one risk factor. Number one, number two, number three. Another point I want to point out is I get fees. So fees are going to be higher on covered call ETFs because there's more work. There's more active management. The average fee in Canada, I would say is about 65 basis points. 0.65 is a very common one. Some a little bit higher, some a little bit lower. And then if they have leverage, that's going to be in the MER. You'll see the MERs of over 2%. So a lot of people would be like, oh, the MER is insane. It's like a mutual fund. What's the point? This is why I showed returns, everyone, and performance. Everyone's got to remember, in case you didn't know, returns, performance, that's net of management fees. And it includes the dividends and income reinvested. So that's why I've been saying it often on my channel. Total return performance is the ultimate truth when you're investigating. Not stock charts, not management fees. Total return is net of all that. It includes all that as well. Yeah, I'm all in this strategy. My family's all in on it. My grandfather is 90. My grandmother is 87. And they're 100% in S&P 500 and NASDAQ 100 covered call ETFs. And it's been going so well for them that they even told me, are you sure this is normal? It's a bit too much. It's too much return. It's too good. Because they're used to put it on the last 20, 25 years, GICs their whole lives. It's only until they saw me on YouTube that they okay, maybe we could trust them with our money. So I feel this is great for, yes, retirees, older investors who want that income, but also for anyone who likes income, likes seeing that income. We have friends, they're 20-year-olds, they just started investing. They're in USCL, for example, on DRIP. The return is going to be very similar to the S&P 500. They love seeing that income. And let's say they need money for their school books 1 month. They could pull that income out without having to sell any of their shares, tax-free, because it's in their TFSA. So there's a lot of benefits. There's a lot of problems that this strategy solves for people looking for income.
Who is this not for and what are the negatives? Because anytime I hear someone say, okay, this is a strategy, it's look at these amazing returns and it's lower risk, right away, just like alarm bells start going off in my head a little bit, right? Because anytime someone says, look, man, you're going to get higher returns, you're going to get lower risk, why would you not just do this? In my experience, at least, 100% of the time that someone has said something like that, there was like, there was a negative. They just weren't talking about it. So maybe you can address that. I'm not saying you're doing that. I'm just saying,
for sure.
Like with any investment, like there's negatives to asset allocation ETFs. There's negatives to the way I invest, which is just buying the underlying asset, like we talked about them, right? The complications and not everyone wants to rebalance, right? So what are the negatives when it comes to your style?
Just to be clear, I don't think, even though some of them do, a couple of them have better returns, the ones with a 25% leverage and corresponding, like the S&P or the corresponding index, I feel more or less you're going to get similar returns over time with those. And the ones with no leverage, you're always going to get a little bit less return. So I just want to be clear. I'm not saying you get more return, because your return is still associated with the asset. You never forget that. So my personal opinion is that if there isn't any leverage, you're going to get slightly less return. You're always going to get less return over time than the index fund or whatever asset it is, because the market goes up over time and you're giving up upside. That's what the covered calls do. That 25% leverage helps close the gap to give you similar returns. My opinion, and as I've proven I wish I had more years of proof, but I would say similar returns. What's the negatives? What are the cons? Well, why wouldn't anyone want this strategy? Well, it's for people who don't need income, don't need these, basically. If you don't need income, if you're in the middle of your career, you could go with just a regular index fund. You're going to pay a lower fee. And surprisingly, now there's even Global X came out with 25% leverage version of the index fund with no covered calls. So that could be now a great option as well if you want more returns over time and you could stomach 25% more volatility. So it's for people who don't need income. They're more in your accumulation phase, maybe don't need them. But again, I gave the example of the two friends we have that are in the 20s that are in their accumulation phase. They love them as well, right? Everyone could use this strategy across age groups and objectives is what I feel. If you don't need the income, you could just turn on the drip. And later on, when you're about to retire, you don't have to worry about selling your units. That's the beauty of it. You just turn off the drip and that's it. Whereas the other guy has to decide at one point when to sell his S&P 500, right? Because with a 1% yield, unless you have $20 million, you're not really going to survive on 1% yield. So what if you retire the year there's a market crash? That kind of would suck, right? So it eliminates a lot of problems later on. But the cons for the most part is you're giving up upside. It's not really a con of the covered call strategy. It's just what it does. You're giving up upside for downside protection. Which
there's always a trade-off, right? That's the reality of investing.
That's the trade-off. And they have higher fees.
Gotcha.
I'll throw one other thing in there, Cornell, that I think is very important. And it comes down to the person's tolerance for risk. And what Adriano said is correct in that if the S&P 500 or when the S&P 500 corrects, you can expect the value of your fund to correct as well with the buffer that those premiums will provide. You threw out a couple of numbers earlier on one of the charts, I think, Cornell, about can you stomach a 30% drop, for example, because there are certain years where that happens. What people forget is that the calendar year was 30%, but there might have been an inter-year drop of 50%. And we saw that back in 08, 09. We've seen, I think, around 80% when we go back as far as the tech crash in the NASDAQ. And those come along, I think will come along again, even despite the benefits of these. And like I said, I own covered call ETFs and I'm not slamming them at all. Why would I do that? Why would I own them if I didn't believe in them? But I also I've been through a lot of the market volatility. And even if you factor in that buffer, a lot of people, if you don't understand that, even though you're buying an S&P 500, which over time has given you these amazing returns, and you buy it today, and then we hit a 30, even a 20% drop, a lot of people aren't going to stomach that if you don't understand what you're getting into. So that's something that I think that isn't said often enough, that comes right back to the fundamentals of the psychology of investing. You really have to understand what it is you're buying. I don't care if it's the S&P or the TSX or gold or Tesla or whatever the asset is, understand how it can behave, and then factor that into your decision.
It's tied with the equity market. So a 30% crash could happen, a 20% crash could happen in a year or maybe a little bit longer. But I personally feel as a long-term investor, you should be able to stomach that. And covered call version helps a lot to stomach
I
that.
don't
Why?
disagree at all. You should be able to, but a lot of people can't. And maybe I have a bit of insight because I work directly with clients for decades. And you may be sitting there today in 2025 going, wow, my risk tolerance is way up here. But you may have not gone through even 08, 09. That's going back quite a ways now. So a lot of people putting their money into the markets today have never gone through that. And until you do, you can look at as many charts as you want, but that's where the rubber meets the road. So that's all I'm saying in that.
Yeah, for sure. No, it's all about psychology. Some people can't stomach it. But with the covered call version, it's much easier because you're still getting that income every month. So it's a lot easier, or I would say you're not going to panic sell. Because what's the danger? It's panic selling during this time. That's the big danger. Obviously, we know that what happens during a crash, what can you do? There's 3 things you could do. Let's be honest. 3 things you could do during a crash. You could panic sell and sell. That's the worst thing you could do. You could do absolutely nothing, which is technically, I would say, a good thing to do. And that's easier when you're having income every month because you don't have to really sell your units. The great thing to do is obviously capitalize and buy more, right? So Mark is right. Yes, you could get a drop for sure because if the S&P drops 20 or 30, you're dropping 20 or 30, cover call or not, my friend, it's the same thing. But you do have that cushion. And from all the feedback I've gotten with newer investors that started with this strategy for 2022, which was a pretty horrible year, they didn't care because the income still kept coming in. And that's the beauty of it. That's the beauty of these covered call ETFs. They tend to do better, outperform, or thrive during the bad times. So that's a psychological boost as well. But like Mark said, there's nothing like experiencing it yourself. I actually went all in, believe it or not, 3 months before the COVID crash. So I got a big taste of medicine right away when I sold my condo, put all the money in. What assets did the best? ETFs did the best, were the most consistent with no distribution cuts or dividend cuts? Covered call ETFs. Everything else, single stocks, single REITs, other stuff, they all cut their dividends. Covered call ETFs stayed stable. And some of them have been out for over 10 years. The ones I talked about are relatively new, but BMO has some that are 10 years old. You could go and check every year the monthly distributions. None of them have missed a monthly distribution.
No, guys, this is a great discussion. I feel like we could have a whole other podcast episode just on this. But Cornell, to bring it back to your original question about who does this not work for, a thought jumped in my mind. So Adriano, please feel free to correct me if I'm wrong. But there's one thing to consider is like the taxable event and triggering a taxable event. So in the event where if your TFSA, RSP, your tax sheltered accounts are maxed out, and now you only have a non-registered taxable account, you get a bit of a disadvantage because if you're not living off that income, if you're not going to spend that income, every year you're triggering a taxable event. You can't avoid paying taxes. If you receive a dividend that year, you have to pay taxes. Whereas instead, if you're in that situation, if you just bought an S&P 500 ETF, sure, you're getting a 1% dividend, but that's really peanuts. You barely pay any taxes on that. The vast majority of your income or your profit will be capital gains. And you don't pay any tax on that until you sell. So in that regard, you can go years, decades before you pay any taxes at all if you're in that accumulation phase. With a covered call, you don't have the luxury. Every year, you're triggering that tax and you have to pay that tax. So something to keep in mind and just plan ahead.
Yeah, that's a good con I forgot. So thanks. That's 100% true. So in a non-registered account, you're getting those dividends. Whether you're dripping them, you're spending, doesn't matter. They're all taxable. So the good news is that most of them are going to be capital gains and ROC. A lot of them have a lot of ROC because anytime ROC stands for return of capital, That's a whole nother podcast I'm not going to get into because there's a lot of misconceptions about it. But basically, the way I think about ROC is delayed capital gains. They're not taxable, lowers your cost base so that when you do sell them later on, it's a higher capital gain. So it's delayed capital gains. But yes, there's going to be a portion that's going to be capital gains. There's going to be ROC as well. So very tax efficient in Canada, but you still got to pay taxes on it, man. And that kind of sucks. So yes, if you are in a high tax bracket, you're in the middle of your career, tax-wise, you're going to be much better off just buying the S&P 500. And like you mentioned, there's a 1% yield, but there's actually, Global X actually has some that doesn't give out any income at all, that has no yield. They just reinvest it. That's even more tax efficient. And again, you could pay taxes later on when you retire, when you're in a lower tax bracket as well. But myself personally, I'm a non-resident, so my tax situation is completely different. But don't forget that RSP contributions still could offset some of that. But you're right. You're going to have to pay taxes no matter what, which kind of sucks if you're in a high tax bracket. Even though it's capital gains, it's taxed a bit better. But you're absolutely right on that. Yeah.
So, Adriano, you're saying you don't get that tax deferral, essentially, because they're going to issue you income, whether you like it or not. You can't just defer it indefinitely like you can if you just bought like a regular vanilla ETF. Did I understand that correctly?
Yeah, correct. The income's coming in, you got to pay taxes on it no matter what. Obviously, the portion that's ROC, you don't pay, but in a bad year, it's possible in a bad year, it's 100% ROC. These accountants of these fund managers could do some really nice things to make it ROC, but most likely there's going to be capital gains in there. So if you're in a high tax bracket, you might as well go with the equivalent without the covered calls, especially if you don't need the income.
Yeah.
If you like this strategy, you could do it in your TFSA and your RSP to test it out, to see how it compares even versus just the index in your cash account, that because taxes don't really matter in there. Or income doesn't make a difference. But it's true. It's a very good point that it could be a problem if you're a doctor or lawyer you're in a high tax bracket and you got to pay capital gains now with those dividends, whether you reinvest them or not.
You're like, I don't need that income because I'm still in the accumulation phase, and you're basically forcing me to report income on my taxes. So I'm actually going to pay even more in a higher tax bracket. And as well too, like as someone with kids and been not basically like semi-retired at this point, the other big thing that comes to mind as well, like in terms of who it might not be for when it comes to these covered call ETFs, is this can have a big impact on your benefits as well, your government benefits, right? So with me, I have kids, I have the Canada Child benefit that I get, and that's an income tested benefit, right? So as my income goes higher, it's going to start getting clawed more and more back. And so for myself personally, I like being able to have full control over how much income actually gets realized, right? Because because then you can basically put the puzzle together in such a way where you get as little clawback as possible, so you get the largest benefit possible. And then, so this is as a parent, most people, it sounds like, that have this are more so, it sounds like, correct me if I'm wrong, are more, they're retired, they're looking for income, they're not getting CCB because their kids they've left the nest. But then I think another consideration would be, okay, what about the government benefits you receive at that point? So for example, OAS clawback, if it gets too high, like maybe you've had a lot of savings, now you're actually reaching the OAS clawback level, there's that piece. And then also for some Canadians, GIS, right? If you're maybe eligible for GIS, that gets clawed back extremely heavily. But with any income, it's such a tight thing to manage if you actually are able to get it. So I'm just trying to explore okay, we've got the menu items. What are the pros and cons of each one? What are considerations? Right. And at the end of the day, I mean, it sounds, correct me, give me your take on this, but I think at the end of the day, if someone is considering this kind of strategy, and especially if they're getting benefits like CCB, which are income tested, and like OAS, which can have clawbacks, and GIS, that is something I think you should run by your fee-for-service financial planner, your accountant, to actually have them crunch the numbers, factoring everything in, run that in your tax software and say, okay, is this really the right strategy for me if we start factoring in these clawbacks? Because that can obviously have a really big impact as well, and is a key component.
Yeah, no, you're right. It's not my area of expertise, I would say, taxes and clawbacks and benefits and all that. But you're right. It would be the same thing with dividend stocks as well. So in the situation you specifically described, when you are getting those benefits and you want your income to be as small as possible, even the same thing would apply, covered call ETFs, dividend stocks, anything that gives income, you would probably try to avoid it in your cash account.
Exactly.
You're
Or
non-registered.
in your
So
non-registered
you would,
account. Yeah.
yeah, so you would go with an index fund or an asset allocation. Asset allocation, there's a little bit of yield there, but
Yep.
Global X has a few, I believe, corporate class type ETFs where it's a TSX 60, S&P 500, and NASDAQ 100, no income. That could be a great option because there's no income there at all for your cash account. But for the TFSA, the RSP, whether you're retired or you're really young, you're in your 20s, this is a good strategy as well because taxes are not a thing.
Yeah, I'm glad you mentioned the corporate class ETFs because we're at 2 hours here, so I don't think we're going to get into the corporate class ETFs. But I'm glad you brought that up because you're right. That is another item on the Canadian menu of TFSA, RSP are maxed out. Maybe you're eligible for FHSA. That's maxed out too. You've got nowhere else to invest your money other than your non-registered account. Okay, you're already in. Maybe you're a high income earner or you're very sensitive to these government clawbacks. You don't want to get clawback. So maybe corporate class ETFs are for you. Like you said, yeah, just for anybody not familiar, they basically take those, they have a kind of a fancy way of taking those dividends and converting them in such a way where they can get rolled back in so that everything you get is basically capital gains or capital losses if you lost money. But this way, you're not getting hit by the dividend income, which a lot of people think dividends are the best thing since sliced bread, but there actually can be negatives to getting income in that way, particularly if you are getting government tested benefits. I'll leave that there because that's a whole nother thing. Actually, my last episode, I talked a lot about that.
By the way, that situation you described where the TFSA is maxed out, that one's maxed out, the RSPs, that's a great situation to be in. So if anyone's listening and is in that situation, you're probably I don't have numbers, but I'm assuming you're way ahead of the game, and congratulations. And
you deserve a pat on the back for sure. Yeah. I was joking about it in my last episode. I said, okay, if you're in this scenario, it's congratulations. And now you're present, your reward for achieving this milestone of maxing out all your registered accounts is that now things get to get a lot more complicated. That's your reward. You got to now invest all these hours of education to optimize things now on the taxable side of investments. But again, a very nice problem. I'm using quotation marks, air quotes here. Nice problem to have, right? It's okay. You've got enough money now where you need to really start thinking about tax optimization to a higher degree.
Let's hope we're also lucky.
Awesome, guys. Thanks so much for coming on. Just to finish things off, I want to give everyone on the panel a chance to tell us where we can learn more from you and see your educational content. Let's go in reverse order this time. Adriano, you went last kind of on your investing style. So why don't you go first this time? Let's start with you.
Yeah, no problem. So we have a YouTube channel, just hit 90,000 subscribers. It's called Passive Income Investing. So obviously the goal is you're investing for passive income. So on this channel, I personally unveil my personal portfolio every single month, once a month. There's also membership where on those exclusive videos, I unveil all my family members' portfolios as well. I'll do live streams where you could submit questions, ask me anything. So those are some of my popular content. I also have a monthly series where I go over the covered call income landscape in Canada and the US. So those are two separate episodes. Every month, we're almost hitting episode 60, I believe, or 50 something. So if you're interested in this style of investing, covered call ETFs, income, that's where you could see my videos. We have a Facebook group as well, private Facebook group with over 14,000 members called Passive Income Investing as well. And I'm on Blossom, of course. You could follow my portfolio on Blossom every single day if you want, which is the streamlining of my portfolio is actually almost complete. So it should all be on Blossom soon. I don't want to spoil anything, but if you want to follow the portfolio, also on Blossom as well. I believe Adrian PII or _ PII, I believe it is the user ID. So yeah, that's it for me.
Okay, awesome. And Mark, you were next.
Oh, similar to Adriano, we have a YouTube channel. I say Brandon and I'll lump us in here because he started the channel, I joined it. Just on YouTube, the channel is called Beavis Wealth. And I think as of just recently or very soon, we'll be hitting 230,000 subscribers. So we're very happy with the growth of the channel there. We also have our online academy. It's called the Investing Academy. Again, if you go to beaviswealth.com, you'll be able to search that up there. It covers all aspects of investing. It's suitable for investors pretty much of all levels and certainly of all ages. And lastly, I'll just push on to our newsletter as well. We publish a newsletter every weekend. It covers economic news of the day. some current insights, a lot of reviews of the economic numbers. We have top 10 performers, bottom 10 performers, oversold, overbought stocks, that type of thing. So it's another resource that you can use there if you want to learn more about investing.
Awesome. Wonderful. Adrian, you're next.
I can definitely vouch for Mark's newsletter. It's one of the highlights of my week. Every couple of days, I read every single one. Top notch. Really well done.
Thank you.
If you want to follow me on my YouTube channel, it's called Canadian in a T-shirt. I think I'm close to reaching 190,000 subscribers now. That's my main platform. Again, you can watch long form videos. I organize and color code my videos. So all my silver thumbnails are taxes, green are investing, blue are stock picks, orange are credit cards. I do a good job of kind of organizing them and making playlists so you can watch these kind of in like sequential order where each lesson flows into the next. Other platforms, you can also follow me on Instagram for more like short form, like 60-second clips of all my YouTube videos. And also follow me on Blossom. I like to write like condensed blog posts, almost like article form of all of my videos as well. And on all of my platforms, Blossom, Instagram, YouTube, the handle's the same, Canadian T-shirt.
Awesome. Thanks, Adrian. Brendan, let's hear from you.
No, I would just echo what Mark said. So no need for the plugs on my end. But I'll finish up this conversation by saying, after this debate about the passive income strategy, this or that, me and Adriano have gone at this on my channel tons in the past. And that's what I love about it, is there's so many different strategies. I am so proud to plant my flag as a hands-off asset allocation investor. To me, this is exactly what I need right now. I don't need this type of headache, but that's what I love about this space, is there's so many different things to consider, approaches for different people. And hey, I think, Cornell, thank you for putting this podcast together, because I think we've definitely been able to showcase a variety of different strategies.
I think so. Yeah, I'm so glad you guys came on. And again, we tried to get different perspective, different styles. Obviously, there is going to be some overlap, because especially there are certain best practices that, and we're all in this space, so we've tried to adapt them to our own portfolios. But as you heard, there are some nuances as well. And again, of course, do your own research, do your own due diligence, go exploring, go down that rabbit hole, explore the menu, see what's right for you. But I hope that by going through this, it was helpful for you to get some clarity on different things and see what's available out there. On my end, for anybody listening to me for the first time on Brendan's channel or anywhere else, again, the podcast is Build Wealth Canada. You can just search for it on your favorite podcast player, or you can go to buildwealthcanada.ca. There you can download all the episodes for free. You don't even have to sign up. You can just download all of them, stream all of them. All of that is free. The ETF guide I mentioned, that's buildwealthcanada.ca/guide, where I go into basically all the ETFs that I buy, why, which accounts I put them in for tax efficiency, all of that. So buildwealthcanada.ca/guide. And yeah, I hope you check out the episode. Like, again, we interview experts like the wonderful individuals we have here today to basically pick their brains, see what's available, see how we can further optimize our investments, our taxes here, specifically here in Canada. And yeah, guys, thanks so much for coming on. Thanks for sharing your expertise. I had a ton of fun. The 2 hours flew by very quickly. And yeah, I look forward to chatting with you in the future. All right, I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.